China cannot sustain its level of growth, but that won't stop them from trying. They're going to all levels to keep supporting the economy, the stock markets, the bond markets, and anything else that they can get their hands on. It's just getting worse and worse. This is no different than their Western counterparts. All nations are doing the exact same thing, following like lemmings, right off the cliff. You came here for the truth, so let me unveil that for you. Today we are going to have our daily dose of truth, and today it's about China. And let me tell you, the truth hurts. Let's begin. Shadow banking rises faster than on-balance sheet credit. And before I start, of course, all countries are doing the exact same thing, but China is not immune to what's going on here. And that's why I like to bring up this information. We can't always talk about the US and what they're doing. We have to understand that all countries are doing the exact same thing. And I always get criticized by those in China who, when I bring up this information, they get very defensive. Why? Why not just call it for what it is? Why don't you want to know the truth? Because it hurts. Total shadow banking assets increasing significantly from 2015 up until 2017 May specifically. That is a change of 35% increase at a time between 2015 and 2017. Think about it. The stock market has been doing well. Everything has been doing well, supposedly, according to mainstream media. Yet, you're going to engage in more and more shadow banking. You're going to pull more and more assets off balance sheet. And yet, claiming at the same time that everything is doing well and everything is sound and the credit markets are just fine. There's nothing to worry about. I don't believe it. Didn't believe it then, and I won't believe it now. That's just the way it is. Total on-balance credit has increased by significantly 20%. It's just the fact that shadow banking happens to increase much faster, much more. Total credit has increased as well. Total credit as a percentage of GDP, 33.8%. You can't do that. You can't sustain that. But look, go to Japan, go to the US, go to Europe. You'll see the same problems existing. It's the individuals, it's the cities, it's the states, provinces, and regions all having the same problem. Everybody's digging themselves deeper and deeper into a hole, and I assure you, you cannot continue this. Liquidity support to the banking system from the People's Bank of China has increased dramatically over the past 12 to 18 months. Look at this. At a time when we have been told that everything is fine, and yet liquidity support has been increasing over the years. Month after month after month. And yes, there are fluctuations, but we're looking at it on average, continuously increasing. Why? You told me everything was fine. You had all of these individuals coming at me on the comments saying I'm wrong. You have those in the mainstream media purporting everything is just fine. Those in the governments, well, we know what they will say. And yet we have the facts. Yet we have the truth. That's all I want. I just want to look at this and realize, what does this all mean? When I look at this information, I need to basically understand, if everything is rising the way it is, and there's nothing real underlying it, is this sustainable? And I would have to say the answer is, of course, no. What will be that spark, that trigger that brings it all down? Well, we'll see. Debt is trending up. China's non-financial debt is now projected to rise even more strongly. Well, of course, this is right from the IMF's own website. And does it surprise anybody? No, of course not. Group of 20 non-financial private sector credit and debt service ratios. Okay, I'm not going to get into that too much, but what I wanted to notice for you was that you have everything is in a group together except for China. It's in a league of its own. This right here is on the x-axis showing you change in the debt to GDP. Huge difference. You have these charts here, you're looking at the house price growth. I mean, come on. Canada has just surpassed anything in the past few years, in fact. But of course, other countries have been going crazy as well. In economies with credit booms, the change in credit to GDP ratio, look at where China is. Extremely high. And that is not a good thing. You cannot sustain that. But of course, we'll learn the hard way. Chinese household debt is rising. So is bank credit. Chinese household debt as a share of GDP and as a share of bank assets. Look at this. As a share of the bank assets, it is increasing to some degree, but as a share, household debt as a share of GDP has been dramatically increasing. The people in China are taking on more and more debt. The banks, in their own way, have been expanding because they've been lending out to those that they shouldn't be. That's important to note. They've been relaxing the lending standards. They've been saying that they've been trying to tighten up, but actually I've shown you the stats here before that they're not. Chinese banks have borrowed, can you believe this, $1.2 trillion from the world. Gross international liabilities of Chinese banks, including Hong Kong. This right here shows you from 2010. So after the financial crisis, Chinese banks have been borrowing. But again, they are all doing this. All of them. You can create an infinite amount of financial assets and instruments and CDOs and CLOs and CDSs and MBSs, and ABS and 1, 2, 3s and ABCs. Doesn't matter. They're all a bunch of garbage, a heaping pile of garbage. And people buy it up. Investors buy it up. They don't know what they're getting themselves into. People are being swindled into purchasing these so-called assets. Their banking managers will convince them you'll get a higher yield, a higher return on your investment. It's rated very well. Have no fear. Well, we saw what happened during the last financial crisis, and this time around, it's going to be a hell of a lot worse. When is it coming? I don't know. I keep saying that, but all I know is that if it continues to increase, the crash is just going to be that much worse. And we don't want that. We want a correction now, and then we can get back to reality. But that doesn't happen. They never let it correct. China intervened in the FX markets, and then ever since, there's been this decoupling that has occurred between the Dow and the VIX here. And I don't know where exactly this is, why exactly that is. But it is very, very clear. Okay, last one. G3 central bank balance sheet, US stocks and US bonds, all in here. Now, there has been, just in the last couple months, a little bit of change. But if we go back throughout 2016, it's clear. As long as the G3 central banks have a lot of money on hand, the stocks and the bonds continue to rise. But if they start pulling back, if they start decreasing the amount that they hold, if they start drying up that liquidity, we are going to have a collapse. This collapse is going to hurt a lot of people because this time around, probably more so than we'll see during the dot-com boom, we are seeing average individuals getting into the markets, more so than before. That's going to hurt a lot of people. They're getting in with mutual funds. They're getting in with stock investments. They're getting in with basically anything they can, not knowing anything, just knowing that the prices have increased. That's the way that they gauge this. Well, the prices have increased, therefore the prices will increase. Well, that's pretty genius. That's great. That's like you're driving down the road. You got 3 green lights in a row. So you immediately assume that you're going to get the next green light. So you don't put your brakes on. Well, I got the last 3 lights in the row, and so I'll be fine. And you end up rear-ending the person in front of you. You can't do that. You cannot do that. Yes, we can use history as a guide, but it doesn't explain what's going to happen right away. We need to track it as it goes on. It doesn't work like that. The way that people factor that in, I really don't think they've sat down for 1 minute, just 1 minute, and try to just think about what's going to happen. They just listen to their financial advisors. They just listen to the garbage that they get on the financial garbage media, and they get what's coming to them. I'm sorry. I'm trying to do my best here. But people, unfortunately, they don't listen. It's going to be bad. If you found this video informative, please give me a thumbs up. And if you found the video informative, I know you'll find my books even more informative. Links are in the description below. Take care.